The American economy is currently bleeding $500 million every single day due to the skyrocketing costs of gasoline and diesel. This isn't a monthly or quarterly statistic. It is a relentless daily drain that continues to intensify. The catalyst was the late February military friction between the U.S., Israel, and Iran, which sent oil prices surging by more than 50% almost overnight. For the first time in history, the Strait of Hormuz, a narrow 21-mile artery responsible for 20% of the world's crude oil and natural gas, has been effectively paralyzed. Consequently, Brent crude has leaped from $70 to over $110 per barrel in just 3 weeks. While the numbers you see on the gas station marquee are jarring, they represent only the smallest fraction of the economic tidal wave headed your way. Most people are staring at a national average that has jumped from under $3 to $3.70, or even over $5.30 in places like California. However, the real danger lies in diesel, the lifeblood of the global supply chain, which has surged 36%. Your mind likely categorizes an extra $15 a week at the pump as an annoying but manageable expense. This is a psychological trap known as mental accounting. We place money into invisible buckets: groceries, gas, fun, and when one overflows, we don't rebalance logically, we react emotionally. According to the National Retail Federation, the first casualties of high gas prices aren't the items that got more expensive, but the optional experiences: dining out, gym memberships, and vacations. Your survival instinct reclassifies these as luxuries the moment a mandatory cost spikes. But gas is only the first wave. There are 4 more massive surges coming for your wallet, and by the time most people recognize the full scope of the damage, the impact will be irreversible. We are currently entering the second wave of this economic crisis: the grocery store. While retailers often try to absorb costs to keep customers, their margins have already been thinned out by previous tariffs. Experts warn that businesses simply cannot eat these costs anymore. Because diesel powers the refrigerated trucks carrying perishables like meat, dairy, and produce, the cost of moving food has effectively gone vertical. Supply chain researchers confirm that grocery stores will be the very next place you feel the sting after the gas station. However, the third wave is perhaps the most concerning because it is nearly invisible. It involves fertilizer. Fossil fuels account for a staggering 80% of fertilizer production costs. Furthermore, the countries currently embroiled in conflict, Iran, Saudi Arabia, and the UAE, are top global producers, and 1/3 of the world's fertilizer supply must pass through the now blocked Strait of Hormuz. This means the input costs for farmers are spiking right now. You won't see the result of this at the supermarket until September or October, long after most people have forgotten why the seeds of this crisis were planted in March. This delay creates a false sense of security. Because the price of a head of lettuce hasn't doubled today, your internal threat assessment remains at ease. This is anchoring bias, using the most visible data point, the gas price, as a proxy for the entire economy. In reality, the International Energy Agency calls this the greatest energy security challenge in history. We saw this exact pattern in 2022 after the invasion of Ukraine. Gas spiked, then the shock bled into rent and services, eventually pushing inflation to 9%. By the time the average person grasped the scope, their purchasing power was already decimated. The fourth wave hitting your bank account is airfare. Since the conflict began, jet fuel has surged approximately 85%. Airlines across the globe, from Qantas to India's major carriers, have already begun announcing fare hikes. Unlike gas prices, which can drop overnight, airlines bake fuel costs into their models months in advance. This means even if oil prices were to plummet tomorrow, your summer vacation tickets are going to remain painfully expensive. Then comes the fifth wave, which few have connected to the war: interest rates. Earlier this year, the Federal Reserve was expected to begin cutting rates, which would have lowered the cost of mortgages and car loans. That expectation is now dead. With inflation accelerating due to energy costs, some economists believe rates could actually go up, or at the very least, the first cut won't happen until the end of the year. If you were planning to refinance or buy a home, the math has fundamentally changed. When inflation shocks collide with geopolitical instability, consumers don't just spend less, they freeze. They delay major life purchases like homes and renovations because they lose confidence in their future affordability. When millions of households pause at once, it can drag the entire economy into a recession. We are staring at a potential stagflation scenario, rising inflation and slowing growth happening simultaneously. It is a corner the Fed is finding nearly impossible to exit. Raising rates crushes growth, but lowering them fuels inflation. Historical data shows that every major oil shock in the last 50 years has been followed by an economic contraction. The financial markets are currently reflecting the chaos in the Middle East. The S&P 500 has dropped 7% from its peak, while the tech-heavy NASDAQ and small-cap Russell 2000 have dipped into correction territory, falling over 10%. Even safe havens aren't acting as expected. Gold spiked to over $5,400 an ounce before suffering its worst weekly crash since 1983. Wall Street's fear gauge, the VIX, has nearly doubled. This is loss aversion in action. Research from Princeton shows that the psychological pain of losing money is twice as intense as the joy of gaining it. A $5,000 loss feels like a $10,000 emergency. However, acting on this impulse is often a catastrophic mistake. Data across 20 major military interventions since World War II shows that the S&P 500 typically falls about 6% during the conflict, but tends to gain 3.4% over the following 6 months. Those who panic sell lock in their losses, while those who hold capture the recovery. Missing just 10 of the market's best days over a 20-year period can cut your total returns in half. You cannot capture the upside if you fled during the downside. Behavioral economists call this the behavior gap, the difference between what the market returns and what investors actually earn because they buy in optimism and sell in fear. You aren't lacking intelligence. You are simply running ancient survival software in a modern financial system. Even if the conflict ends tomorrow, relief won't be instantaneous. This is due to the rockets and feathers effect. Prices shoot up like a rocket, but drift down like a feather. It takes weeks to ramp up production and months for prices to ripple back through the supply chain. So, what can you control? The difference between those who emerge from economic shocks stronger and those who don't is response time. The best faring households are those who adjust earliest, making small, unglamorous moves before the pressure becomes unbearable. First, do not panic sell. Moving to cash replaces market risk with inflation risk and opportunity cost. Second, pressure test your emergency fund. Financial advisors recommend 6 to 12 months of expenses in a high-yield savings account, which are currently paying over 4%. This fund is less about interest and more about fear insurance. It prevents you from making desperate, expensive mistakes. Third, audit your spending now. Don't wait for all 5 waves to land. Cut discretionary spending proactively and redirect those funds into your cushion. Fourth, utilize dollar cost averaging. By investing a fixed amount every month, you automatically buy more shares when prices are low. Years from now, the shares you bought during this crisis will likely be your best performing assets. Finally, map your specific energy exposure. If you have a long commute, your vehicle's math has changed. If you have credit card debt, attack it now, as rates won't be dropping soon. The window for proactive adjustment is open right now. Don't let your nervous system choose for you. Make the decisions yourself. The story of this crisis isn't over, but your preparation should be. What is the first move you're making to protect your future? Let me know in the comments, and don't forget to subscribe to stay ahead of the next wave.